So welcome back, everybody, to another webinar organized by Princeton for the whole world. Today, I will actually talk my own on finance, money, and climate change. It's a policy paper I wrote for the Economic Policy Journal, together with Jean-Pierre Landau. And I would like to outline, some of these challenges, some of the policy measures, the policy changes, which are connected to climate change, and what finance and monetary policy can do about it. And thanks for joining us. It's a pleasure to have you with us again. So what the motivation essentially is, there's a sense out there, climate change is a very urgent problem. And so we have all hands on deck have to work together in the same way. So it can't be that only one type of policy is dealing with climate change and the other policies are not dealing with that. And part of it is green finance. And another part of it is the greening of monetary policy. And I would like to zoom in both of these elements a little bit further today. And what are the challenges? What are the trade-offs? And how to think about them. So please submit your questions in the Q&A box. And then I will try to address the questions as they come in, most likely at the end, in order to we have a Q&A session subsequently. Now, you answered already some poll questions. So let me just tell you the poll questions as well. So what was the reaction to the poll question? So the first question was, is ESG, like the labeling of financial assets based on a rating, an ESG rating, environment, social and governance structures, is this an effective tool for climate change? And actually what people said is, and only 39% said it's an effective tool, and 61% no, it's not an effective tool. The second question I would like to pose to you, and have posed to you and you gave me an answer to, is what is should be the preferred option to incentivize pollution reduction? Should it be a Pigouvian tax? Should it be a tradable permit scheme? Or should it be some green finance? And the answer was 39% for Pigouvian tax, 36% for tradable pollution permits, and only 25% for green finance. Of course, one doesn't exclude the other one. But essentially, that's the preference, which one should be the most preferred one. And then the final question was whether monetary policy should actually contribute to the climate change. And the answer here is actually split 50-50. 50% said yes and 50% said no. So perhaps you will change your mind afterwards, but it's a good guideline to have how people think about these questions in the beginning. Now, before I start, I would like to start with some basic principles and what are the challenges for policy making more generally. If I look at the policy functions a la Richard Musgrave, a public finance hero, I said that there's three functions of public policy. One is allocation of resources and production capacity. Another one is redistribution, so redistribute some wealth. And the third one is stability, price stability and financial stability. Of course, allocation has also some risk allocation to it, and how you allocate the risk will affect also the endogenous risk, so how much risk there is in total. So the allocation is not just on distributing the risk accordingly, but it also will affect how much risk there is in total. And that, of course, when there's a lot of endogenous risk, including crisis risk, amplifications, and so forth, that has also implications for stability. So allocation and stability is, of course, connected. So is redistribution, but you can think of this as a basic three functions, which we were taught in public finance based on Richard Musgrave's classification. And of course, stability, that's where central banks come into play very heavily as well. So these are the policy functions. And the question is, what are the policy instruments? So the next slide is about policy instruments. And the question is, so if I want to bring all policy focused on climate change, should there be specialized policy instruments focused to do the greening, or should there be a multi-purpose one? And how should one evaluate that, whether the greening of existing policies? So I look at existing policies, and should I make them all green, take a green component part of it? And how should I evaluate that? So the first one is the effectiveness in addressing the climate change. So it might be very effective to make a monetary policy or other policies which objective is a different one, like price stability, to also carry climate change considerations, or it might not be effective. And the other question is, second criterion should be how much do you interfere with the original policy objective. Okay, so in the extreme, should you could think of that like healthcare is one policy. Should healthcare have some greening component as well or not? But the consequences, of course, if you green all policy instruments, so if you take also a greening component to that, you diminish the accountability, and you also might, I will come back to this, weakened independence if some of the policies are outsourced, some independent agencies like central banks, you might have some elements of that. So these are the basic conceptual things, and to have a background, what are the functions, what are the policy instruments, and then there's also a challenge in terms of horizons, what policies, different policies have different horizons. And that goes back to Marconi's speech saying the tragedy of horizons. So if you think about climate change is a long-lasting thing. So we have to act now and, in order to fix that, but it has some long-lasting implications on climate change. And so that's why, but it has, we're talking about decades. It's a cumulative process. There are local shocks. First, there might be a lot of the shocks might be idiosyncratic, but we might also hit some tipping points and has some long-lasting implications. Okay, so while it is a very long-lasting process, what we do now will impact already how it will play out. Now, if you look at other policies like financial stability, it has a horizon of based on the financial cycle. So financial cycle, typically risk is building up in the background, then it erupts and then translates into a crisis. That's about a horizon of 8 to 10 years or perhaps around that number. There's this volatility paradox I mention often, where you say, okay, is something which seems very safe, very robust, and doesn't move much. That's actually is only a sign that risk is building up in the background and then erupts later on. Something which is more volatile might be more resilient, might be more easily to bounce back because it constantly moves around and is also bouncing back more easily. And essentially that's a 8 to 10 year horizon. And if you think about monetary policy, it's mostly a 2-year horizon. So it's much more cyclical. It's about business cycles, and it depends on the stickiness of the prices. And, so there's macro financial, of course, long-term prospects too, but it has a much shorter horizon. So if you think about the Keynesian framework, it's about the price stickiness. You don't talk about decades, you talk about, few years at most. And of course, the climate interaction is also there, and I will talk about this later on in monetary policy. It might impact the benchmark, the R star, and we will go to this R star in a minute. Now, what I want to do is I outline these basic concepts. So I want to go beyond these basic concepts. And then I want to talk about green finance and then raise some new issues there. And then I talk in a second step, I talk about green monetary policy. So first the green finance component and then the green monetary policy component. So the first thing is, what is the sources of climate risk? So essentially the way, and this came also in the poll question, one way to deal with it, to have tax pollution. So we tax the pollution, that's what we really, the emissions of CO2, we tax this directly. But when you do green finance, you tax essentially risk associated with that. Finance is mostly about risk. So it's risk associated with pollution. So if you imagine that there's particular risk attached to that, and then you tax the risk, then you would also tax pollution if the pollution and risk is associated with each other. So the question is, what risk is climate risk? So what are the sources of climate risk? Then of course there is, the first effect is that there are some climate events cause some risk. So there might be some flooding, there might be a drought, there are fires and so forth. So you have a lot of climate risks directly. And this might lead to stranded assets. So stranded assets are assets which are available, but suddenly there's a climate event, then the asset is worth much less. But if you think about the risk in finance about stranded assets, which is a big risk component, it's not really about the climate events themselves. It's much more about the policies. Suddenly the policies is changing, an existing policy is changing, and that means now suddenly the asset is worth much less. Or it can be existing policies, it can be future policies, but both of that leads to stranded assets. So the risk associated with climate is from climate regulation. And I think that's, of course, there's a risk with climate events, but the bigger risk, I would argue, and more systematic risk, so it's not localized where there's some flooding in a particular region or some drought in a particular region. The big risks for certain asset holdings is that suddenly there is a policy which outlaws certain activities or taxes it heavily. That's essentially where the risk is coming from. And then the question is, how do we, if we tax that risk through climate finance or green finance, how will this play out? Now, the other thing is I would like to say, of course, if we want to focus on the risk, we have to incorporate this in our stress test analysis. So when we regulate banks and so forth, we have the internal capital adequacy assessment process has to be adopted to that. The portfolio of insurance companies and regulation, what insurance companies, how much equity have to put aside for this has to be affected. And also for many institutional investors or asset managers, it has to play an important role of this. And there's a parallel and integrated climate and macro scenarios. So we have to have not only in stress tests, macro and economic financial scenarios, but also climate scenarios. But the point I would like to make is that there's an interaction between this policy risk and the stranded asset, and there's a feedback loop back and forth, and that leads to potentially multiple equilibria. And that's a self-fulfilling prophecy. So let me just illustrate that if once you take political economy considerations into account, things change to some extent. So let's consider the following. Let's suppose there's limited climate risk provisioning. So we don't have the risk of assets becoming stranded assets. Hence, there's few risk weights on it. There is not much equity put aside for the possibility that assets are worth much less. So then there will be, of course, huge political opposition to impose strong political measures, and there will be lobbying pressure to not to do that. And because of the strong lobbying pressure, there will be not so many stranded assets, which justifies that you didn't put so much risk weights and so many risk considerations into place in the first place. Okay, so this one outcome essentially is there is not much risk capacity built up for potentially stranded assets. That means there will be a lot of lobbying pressure, a lot of resistance to have these policy measures for climate change, and hence the assets will not become stranded, and that justifies why there was only some limited provisions in the first place. But there's a second outcome. The second outcome is that, you know, in the first step, we say, okay, wow, it could be that these assets become stranded, and hence we have to put a lot of equity cushion into the banks and all the financial players. And then this opposition that there will be, you know, these assets will then become stranded will be much less because we have already put some buffers, some reserves there. And then it will be much more likely so that we have stranded assets, which the exposed people say, I told you so, we need all these buffers because the assets become stranded. So there's a self-fulfilling prophecy, of self-fulfilling element to it, which is important to keep in mind once you have to recognize that most of the risk of the stranded assets comes actually from policy uncertainty. And I will come back to this policy uncertainty further and further, because I think that's, if you take the finance perspective, that's an important aspect to shed a light on. And what I want to change your mindset a little bit is a little bit of a strange way of thinking, but you know, we can put some Pigouvian tax on the pollution. That's a direct way of doing that. But we can also what I call a policy uncertainty tax on it. How does this work? So this works essentially that we say we create policy uncertainty. Because of this policy uncertainty for polluting production capacity, it is actually more expensive to fund that because this uncertainty will cause you need some risk premium. Somebody who is funding you, he wants a risk premium because of this policy uncertainty. So essentially the uncertainty itself, the policy uncertainty acts like a tax instead of a regular tax where, okay, I charge you a Pigouvian tax and they have to pay some tax to the government. Said, I don't charge a tax directly. I create uncertainty, policy uncertainty. And then the investor says, oh my God, there's so much uncertainty. I would like to have a risk premium for this uncertainty. So the risk premium itself is essentially then the Pigouvian tax. Okay, so, and this risk premium itself has the same feature as a Pigouvian tax. It is stirring investment away from polluting production capacity, more to green production capacity. But there's one big difference. And if you think about it, so the one big difference is that in the Pigouvian tax, there's a government getting some tax revenue. But while you could do this policy uncertainty tax, there's actually no tax revenue for the government. It's just socially wasted because the investor has to bear some additional risk, which is created endogenously. And this additional risk is essentially, a welfare loss to everybody. It's still steering the economy away from polluting assets. So it has still this feature of steering the economy, but it doesn't generate a tax revenue for the government, which you could allow you to raise some below some other taxes. Okay, so there's a huge welfare loss. So it's much more direct and much more obvious. Again, we tax the pollution itself rather than we create uncertainty, and then through the financial arrangements, because of this increased uncertainty, we will ask for more financing limitations. And this way we steer the economy because it doesn't generate any income for the government. It has the same element in terms of pushing the economy in one direction, but we lose the tax income. So that's on a static perspective. So you might think, oh, that's already a little bit a crazy approach to do it, but it might be politically more feasible approach. You can also put this in a time dimension where you get some time inconsistency perspective. So let me just illustrate this again, where we now take an ex ante perspective and an ex post perspective. Okay, so ex ante, I just said it would be much better to have some Pigouvian tax explicitly laid out, have a clear path how to scale it up over time, and remove policy uncertainty. Don't work with policy uncertainty as a way to have an indirect Pigouvian tax. Remove policy uncertainty. So you can actually, what you can do is you can have a pre-specified price path for CO2 emissions, or you can also have a pre-specified quantity path. So if you have a pre-specified price path for CO2 emissions, you can do this with CO2 taxes, a carbon tax. And this way you reduce risk premium. If you're more focused on the quantities, that is how much the quantity of emissions should be controlled, and I want to put certainty on there, you can do tradable permits. So you have pollution permits and you fix the quantity and you scale the quantity down over time. So this way, both way, whether you fix on prices or you fix on quantities, you can reduce the risk this way. You can also do a mixture of both. So if you have pollution permits and then you manage the amount of pollution permit outstanding based on the price, that's another way to capture both, to minimize the price volatility and the quantity volatility, to have a convex combination of the two. So from an ex ante perspective, say actually what we do is we fix the path going forward. This gives a lot of certainty. That makes it actually easier for the new technology to be invested in, because everybody knows what the price will be, the CO2 price, for example. And this way, there's a clear path, there's less risk involved, and that actually reduces the risk premium, and that makes it easier to invest. But once you lock yourself in on this path, you might learn over time later on that the whole environmental threat is much bigger than initially thought, and you might be much closer to a tipping point. It might become apparent that the Gulf Stream is stopping, and is once it stops, you can't bring it up, start it again. So that the tipping point is much more closely related to that. So in order to have resiliency, you need this flexibility that you can adapt and react and re-optimize and all that. So exposed, you would like to keep some flexibility, and that's where the classic tension is between ex ante committing to a fixed thing and exposed being flexible to readjust. And that's where you have this time inconsistency. So ex ante, you would like to fix a path, commit to a fixed path. Exposed, you would like, as you learn more, readjust and stay flexible. And that's where the tension and time inconsistency tension comes in as well. So let me just say, so I think it's not a good idea to work with policy uncertainty, because treating policy uncertainty, nobody says it this way, but that's essentially what's going on. Create a lot of policy uncertainty, potentially stranded assets, that makes the funding of potentially stranded assets very expensive. because of a higher risk premium. It's better to charge taxes straight out and make it in a very deterministic way where there's less uncertainty. So that's less welfare loss in achieving that. But you have to keep in mind that ex post you would like to re-optimize if new things are learned. So there's this time consistency one has to handle on top of it. Now, another issue I would like to mention, which is an interesting phenomenon, is that you can either tax pollution directly or the output of the firm which pollutes, or you can tax one particular input. So if I have here a production function, there's an output, and then there's input is labor, capital, and pollution. And if let's suppose if there's a highly polluting firm, I charge a higher tax on capital financing. So if you go for green finance, you put a tax on capital financing. So that means essentially you charge one input higher than the other input. Of course, you distort the input ratio between labor and capital, and it's not clear why would you do that. You might say, I have a general tendency we should actually favor labor, but that's a different objective. But it's not clear if you have a high polluting firm, you should actually then distort the labor capital ratio, because the labor could be equally part of the production. So that's essentially another distortion one has to watch out for. So that's another argument not to necessarily focus only on green finance, because you focus only on the funding of the capital, but you might want to tax the output good significantly. But of course, politically and the distributional aspects one has to take into account as well. Now, finally, I would like to say how to implement this green finance thing and what are the different options on the green finance elements. So, of course, one is to bank regulation. So you just put certain risk weights on that. So if you have potentially stranded assets, you have a higher risk weight, and the bank then has to provide more equity financing for that, which is more expensive. And this way you make the bank sound should these assets become stranded, because some policy measure is taken into place. And there's a whole list of challenges on the taxonomy, where right now in Europe in particular, the European Commission is developing a taxonomy, what's green and what's less green and so forth. The challenges there are that the following, that some green investments might be inherently more risky. Okay, so but we want to favor green investments. So the question is a challenge there. If you focus on risk, if the green investment is more risky, how to deal with that? Okay. The other challenge is, if you go more from a central bank perspective, is that you have more. If the authority decides what's green and what's more green and what's less green, then actually an authority is really directing credit in a certain direction or not. And then you're subject to lobbying pressure. You're subject to crony capitalism and all that. If you just say all the things are based on riskiness, then there's a neutral standard. And as soon as you have some subjective thing where something is more or less green, you have to be very careful to have very objective measures. If you don't have these objective measures, then actually you're subject to lobbying efforts, and you see these lobbying efforts already going on. And who decides what's green and what's not green? And there's all this greenwashing. Many things are suddenly treated as green, even though they're not so green after all. And this shows very clearly in two papers I would just highlight, ESG ratings, or two analyses, where one essentially shows that if you look at gross ESG ratings, the correlation is very, very low. Okay, so but it should be that the certain assets, they're either green or not green. And why is the correlation so low that depending who is rating it, some people rate it this way and the other people are rating the other way. And also, if you make a correlation, there's an IMF paper showing if there's a correlation between actual emissions and the ESG rating, it's also extremely low. And so you might say, the ESG rating is in the early stages, so there are still some hiccups and it takes a while to grow, but there's many, many challenges. And of course, it's a lucrative business to be in this ESG rating, because you decide who can get cheap funding and who is getting not cheap funding from the financial markets. And that's very lucrative as well. So there's a lot of money to be made. So let me keep this for the green finance aspects. Now let me move for a few minutes to green monetary policy, because that's equally important. We have already alluded to it, financial regulation. interacts with monetary policy, of course. Now, so central bank policy produces, of course, spillovers. It has implications, and there's always this principle of market neutrality, particularly if the central banks are purchasing assets. And the question is, what does market neutrality mean, and should market neutrality be really maintained? So there's an economic aspect to it, where you say, if there's a market failure, should central bank be so neutral to keep the market failure? Okay, so that's one aspect, saying, okay, market neutrality is not a guiding principle, because why would you stick with market failure if without intervention there's a market failure? Now we intervene in such a way not to fix the market failure. That's an economic argument. There's a political argument as well. The political argument goes the following. It says, if all of the politics tries to make the whole environment to have a better environment in the sense that there's less pollution, why should then central banking not be part of it? Okay. And that's another argument, that we should to give up market neutrality. And that's things to consider. Now, the next thing I would like to raise is that, typically for monetary policy, it's often argued, R star is a guiding measure. So it guides us whether monetary policy is contractionary or expansionary. If the policy is above R star, then it's a contractionary measure. If it's below R star, it's an expansionary measure. And what determines R star? And of course, R star is driven by a lot of structural forces. How big is the precautionary savings in the economy? What's the investment? What's the growth rate of the economy? All of this is determining our R star. And of course, if R star is very close to zero, there's less room, less space for monetary policy, because you're hitting essentially much more easily the zero lower bound or the effective lower bound of reversal interest rate as well. So this R star is a very important concept. And it is interesting to figure out, how does the climate policy, other dimension, or does it really impact R star? And if it impacts R star, then it should impact also monetary policy, because how can it be isolated from R star? So R star is, let's just think about how could climate policy impact R star? So if, like in Europe, there's huge investment direction now towards climate issues, and that leads to huge investment demand. So huge demand is going in this direction, and that leads, of course, to an increase in the interest rate, holding everything else fixed. So ceteris paribus, R star would increase. So what does this mean then for monetary policy? Does it mean, in general, we should have a higher, higher interest rate? But there's some other countervailing effects as well. If the case that we redirect a lot of investments into green investments, and if they don't contribute to higher consumption growth down the road, then actually that lowers R star. So this one of my favorite formulas. So you have the risk-free rate is just the time preference rate. Then we have this Ramsey term, which is expected consumption growth rate in the economy times the intertemporal elasticity of substitution. So this gamma is the curvature of the utility function, minus this precautionary savings term that depends on the volatility of consumption. And again, this gamma is also the curvature of the utility function, is also the risk aversion coefficient. So you have two forces pushing in the opposite direction, pushing R star down. One is if the expected consumption growth rate goes down because you do all these climate investments, which don't translate into higher consumption growth, but translate into a cleaner environment. And that's already one component pushing R star down. And then you have all this increased risk because of stranded assets or political uncertainty from these policy measures, or just strictly climate risk from climate events that leads to a higher consumption uncertainty, leads to more, with this minus sign, leads to a lower R star as well. So those are the channels, and that's an interesting research challenge to figure out, will this effect, which increases because there's huge investment demand, that will increase R star, or it will be decreasing because of these other two forces, and how to capture this and calibrate this in a coherent way in a framework. Now, of course, what are the instruments? So what for monetary policy, what are the instruments? Of course, you can change the haircuts when monetary policy lends to banks and charges for some assets as collateral. It can charge a higher haircut or lower haircut. So how many assets you have to give the central bank as a collateral, depending what the haircut is. The central bank also are very active in purchasing assets. So here I've that's a figure just drawn from my book. We're seeing just how much the assets exploded since the global financial crisis and then the COVID crisis again. How big is the balance sheet? So that's the asset side of the balance sheet, and that's below the zero line is the liability of the balance sheet. You see they're expanding a lot. So they bought a lot of assets. They bought a lot of corporate bonds and other risky assets. And some of them, many of them are non-green assets, and only a few of them are green assets. Should essentially the asset purchase program, the newly purchased assets should be tilted towards green assets or not. And again, we get to this credit policy, then we favor one investment over the other investment, like what we did in the 1970s. And there was a huge movement away from this credit policy and be more neutral, be market neutral. Now, even more aggressive approach would be to say, we have the existing balance sheet has a lot of non-green assets. Let's sell them and replace them with green assets. That would be a more radical move even further. Now, if the final thing I would like to mention is that green monetary policy, how does it interact with central bank independence? And I alluded to this accountability argument before. So first of all, if you do monetary policy in a country without central bank independence, so it's an autocratic society, and monetary policy is essentially done by the finance ministry anyway, because it's not outsourced to an independent agency like the central bank, which is an independent central bank, then this is not an issue. So then it's fine. But typically, the understanding is going back to our functions, the resource allocation and redistribution, that should be done by elected bodies. So this should be done by the sovereign, the people who elect some representatives who then decide about the resource allocation and redistribution. But in many countries, in democratic countries, we have an independent central bank. You have a clear specified mandate for the central bank. So like in the US Fed has a dual, essentially a triple mandate. So it's not only about low inflation or price stability, but also employment, and also the long-term interest rate should be stabilized. These are their mandates for the US Fed, while the ECB in Europe has much more hierarchical mandate. It first and foremost cares about the price stability, and to the extent this price stability is satisfied, it has secondary objectives to support the overall European Union-wide objectives. But then it raises a question. So if the first objective is satisfied, and then you go to the secondary objective, who picks which secondary objective should the monetary policy focus on? And should it be the central bank itself choose its preferred secondary objective? Or should it be an elected body like the European Parliament deciding what the secondary objective is? And but then if the elected authorities are anyway deciding what the secondary objective is, why don't this elected body doesn't immediately directly impose some Pigouvian taxes? They're the same institutions, same parliament or Congress deciding on Pigouvian taxes in the first place. Why do you go through the central bank? But in any case, you see already how subtle this interaction is, and it drags the central bank deeper in a political Rome, which you typically should try to stay away from, because central bank should not be part of the political cycle. It should be independent in order to overcome this time consistency problem. Typically, central banks try to overcome, not to be part of political cycle more generally. So let me conclude. And what I try to point out in this short presentation is that what are the challenges with climate change and the interaction with finance and monetary policy? And I said that first of all, it's very important to think about the three functions of policy, a la Richard Musgrave. allocation, redistribution, and stability, where central banks have a huge role in price and financial stability to play. And the greening of the instruments, should we make all these instruments we're having multi-purpose, so they have to satisfy the initial purpose of the policy instrument, like price stability for, or there might be an extreme health or something else? Should we green them all or make them multi-purpose, or should we keep them targeted? And we have special targeted instruments also for the climate aspects. And then there's the strategy of horizons, where we say, you know, there are certain policies which have different horizons. Monetary policy is 2-3 year horizon, depending on the business cycle. Financial stability, 7-8 year horizon. While climate change is different, it's over decades, it's a very long thing, but we have to act now too. So the implications, we cannot wait for decades, but the implications, but overall the horizon is a different horizon. And then there's the green finance component, and what makes green finance work essentially if you change the risk, and the risk you can change through policy uncertainty. But that's a very ineffective way. So a direct Pigouvian tax is much more effective to deal with that, while a climate risk, you know, creating through political uncertainty is also creating some tax implicitly, but there's no tax revenue. It's just totally wasted in terms of creating some additional risk premium costs for the company to fund itself without, you know, because you get the disutility from this risk for the investor, instead of, you know, some third party, the government, getting some dollars from that. Then there's this whole issue about greenwashing, the ESG rating at this stage essentially not doing their job. And then there's a distortion of the right margins, where you distort, of course, the capital versus labor ratio as well. And then there's this whole time inconsistency I was talking about. You want to bring essentially uncertainty down, prescribe a clear path ex ante to minimize the risk premium, but then exposed, you might have to readjust as well. And then in terms of monetary policy and green monetary policy, it is there's a, you know, this new policy will be acting like a supply shock because there's a lot of restrictions, regulatory restrictions coming in. How will this affect our star? There will be an investment boom, hence it might be our star might go up, but there's also more uncertainty coming in, and there will be lower consumption growth rate. Both will push our star down, and it might also threaten the independence of the central bank, because it gets into political realm. And then, you know, once the central bank makes policy in these dimensions, what prevents other politicians to say, oh, because you to be part of our policy realm, we would like to be part of your monetary policy realm as well. So with this, let me thank you a lot for participating and being part of it. And I'll try to perhaps go to some of the questions which were put in the Q&A, and then answer them. But I will only pick a few because it will be hard on the fly to answer them. So thanks again for discussing this. It's probably best if I come back to you by answering these questions offline. So this way we can answer them more clearly.